I think it was the case of everything else kicking in very solidly, offsetting the headwinds from the interest rate. Quite clearly, the zero interest rate environment takes its toll, and for a bank like ours, which is very long on current account and savings account deposits, in fact, 76% of our deposit base is in that category, that headwind is quite significant. The good news is that the business momentum everywhere else was very strong. Loan growth was strong, fee income was strong, particularly as you said in wealth management, but also investment banking fee, transaction services fee, cards came back. And interestingly, the markets business was very robust as well. Not as strong as the first quarter, but nevertheless very strong relative to through cycle averages or last year. And therefore, when you put all of that together, we almost made up the entire loss on the interest account as a consequence of the low interest rates. You also referred to the cost of credit. It's actually quite interesting that not only is business momentum growth good, the overall portfolio quality has been quite robust. We are not seeing any of the stresses that we'd originally anticipated come through. So that's been positive as well.
Yeah, that's interesting. Why aren't you seeing these stresses, given that Singapore in particular and other parts of Southeast Asia are continuing with these lockdown measures? I want to talk to you about loan growth as well. You updated your loan growth forecast for the full year to mid to high single digits. What is going to drive that? Are people out there in lockdown really sitting down, holding off, waiting until we see a reopening of the economy before they make decisions, whether it comes to loans or mortgages and the like?
Matt, the large part of our book tends to be corporate and institutional. And within that, the only sectors which are suffering a bit are, tourism and F&B. The rest of the economic activity around the region has been quite robust. So if you take real estate, TMT, telecom, media, technology, you take the logistics sector, exports are booming. And therefore, the fact that you have lockdowns in some countries is impacting only a thin sliver of the economy. Many other sectors are doing fine, and you can see that in the macroeconomic aggregates. Both the GDP numbers, but also the PMI numbers have been very robust around the region. So that's what shows through in our economic activity. Your question on, with pandemic increasing, why are we not seeing more stress? I do think that there will be more stress in the consumer portfolios. That's where the increasing pandemic might have some impact on SME. Some of that is being masked because of all the government monetary and fiscal policy stimulus actions and the moratoriums. But, I'm also been surprised, pleasantly surprised, with the amount of resiliency that there seems to be built into both individual and SME balance sheets in the region. Because even as moratoriums are ending and loans are coming off the moratoriums, I'm finding that delinquencies are not going up that sharply. And so it just speaks to the fact that the consumer as well as the SME was a lot more resilient than people had anticipated all along. I think one factor to that, of course, is the zero interest rate environment. Rates are very, very low. So the actual amount of debt servicing that is required to be done is not extraordinarily high.